Last week, we exposed the hidden tax bomb inside Social Security. The reality that the one big beautiful bill didn't actually fix taxation, it only delayed it. That can feel frustrating, even overwhelming, especially if you're already trying to make your retirement dollars stretch. But here's the good news, you're not powerless. Today, Carl and I are going to walk you through 5 practical strategies that can help you keep more of your Social Security check in your pocket and thrive through this important retirement transition. Hi, I'm Vicki Joern, financial advocate and host of Thriving Through Transitions, and thank you for joining today. With me again is my business partner, Karl Joern. Karl is a registered Social Security analyst. Last time, we laid out the problem. Today, we're focusing on solutions.
That's right. And I think people will be surprised. They have more control over their tax picture than they realize. Let's break down the 5 steps.
Great idea, Carl. Step number 1, you always say the first thing retirees need to know is their provisional income. What exactly is that, Carl?
Well, provisional income is the IRS's way of deciding if your Social Security will be taxed. It's your adjusted gross amount plus any tax-exempt interest plus half of your Social Security check. And if that number crosses certain thresholds that we talked about in the last episode, then 50% up to 85% of your benefit could be taxed.
Hold on. Tax exempt interest? A lot of people hear that and they think they're safe. What does that actually include?
Great question. What usually interest from municipal bonds is not taxed because it's money that is lent to either a city, a county, a state, and even federal for certain bond funds. It's called tax exempt because you don't pay federal taxes on it directly. But then here's the catch. The IRS still counts it in your provisional income for Social Security.
So even though it says tax exempt, it can still make more of your Social Security taxable?
Exactly. Say you earn $2,000 in municipal bond interest. You don't pay federal tax on the interest itself, but the IRS adds it into the formula for provisional income, and that could push your Social Security into the taxable zone. It's like those hidden fees on your phone or cable bill that you didn't realize were there. The headline price looks good when somebody offers you something, but then you get hit with that little extra that you weren't expecting. That's how provisional income works. The fine print still shows up in the calculations.
That's sneaky, but very clear the way you explained it. So step 1 is simply turning the lights on. You can't avoid what you can't see, and knowing your provisional income makes those hidden traps visible. So, all right, let's go to step number 2, being strategic about withdrawals, Carl. Can you give us an example?
Sure, picture 2 different retirees, both needing $30,000 this year in income, in addition to their Social Security. So retiree A takes $30,000 from their traditional IRA. That pushes up their provisional income, so more of their Social Security gets taxed. Now, retiree B takes $15,000 from an IRA and $15,000 from a Roth. Because Roth withdrawals don't count towards provisional income, less of their Social Security is taxed.
The same amount of money coming in, but one pays more in taxes than the other.
Exactly. That's why it's not just about how much you withdraw, it's about where you take your withdrawal from.
That's a huge shift in thinking. For many retirees, the focus was on savings. But in this transition, How you spend and where you spend matters a lot. So, step number 3, this one is unique to the big, beautiful bill. Carl, explain the 4-year window.
Well, from 2025 to 2028, single people 65 years and older get an extra $6,000 deduction, as we discussed before. Couples get $12,000 deduction. This temporarily lowers the taxable income. And I believe that most people will fall in this bracket where I've heard President Trump say 88% of the people would not pay taxes on their Social Security. For an example, a couple usually in the 22% tax bracket might drop to the 12% tax bracket within deduction. Now that's a perfect time to do a Roth conversion or withdrawal from an account that is taxable at a lower rate.
But what happens after 4 years?
The deduction disappears. It's like a coupon with an expiration date. You either use it or you lose it.
Good analogy. So, step 3 is about recognizing this transition window. It's short term relief, but if you use it wisely, it can reshape your long term retirement taxes. So, let's talk about step 4, Roth conversions. To some people, this sounds very intimidating. Can you break it down for us, Carl?
Think of it as moving money from one pocket to another. You take money from a traditional IRA or a 401k, where withdrawals are taxable, and move it to a Roth IRA, where withdrawals are tax-free.
So, you pay taxes now instead of later.
Right. For example, if you convert $20,000 this year from an IRA or a 401k, you will pay taxes on it now at whatever your tax rate is. But later, if you take those funds and put them into a Roth and that grows, the Roth income that you would take later on won't add into your provisional income formula, which keeps your Social Security from being taxed more. Of course, Roth conversions aren't for everyone. You need to review your tax with your tax advisor to make sure it fits your situation.
So, step 4 is basically pay some tax today to protect yourself from paying more tomorrow. Would you agree, Carl?
Yes, and Vicki, I would like to share a story that we always do during presentations, and that is, would you like to be like the farmer that pays tax on the seed up front and then profit from the crop later on? Or would you rather just pay for the seed and then later on, when the crop comes in, you pay your taxes on that crop?
That's a good analogy. What do most people say to you, Carl?
They would rather pay for the tax on the seed up front.
That's right. So that's what thriving through transitions is all about, is looking at the whole picture. So step 5 is plan for inflation and speak up.
Exactly. Every cost of living adjustment raises your Social Security check, but thresholds haven't changed since the 80s or 90s for provisional income. So you feel like you're getting ahead, but in reality, the more of your benefit may get taxed as time goes on. For example, if your benefit grows from $24,000 now to $26,500 in 4 years, you might feel better off. But if the threshold stays the same, more of it could be taxed.
Mm-hmm. And that's just the inflation side. What about the advocacy side?
That's big. Retirees have a choice. The rules won't change unless people demand.
Mhm.
Contact your representatives. Ask for reform. If we don't speak up, nothing changes.
So step 5 is plan for inflation and don't be afraid to raise our voices. Let's recap the 5 ways to keep more of your Social Security check. Number 1, know your provisional income. Number 2, strategize withdrawals. Number 3, use the 4-year window to your advantage. Number 4, consider Roth conversions. And number 5, plan for inflation and raise your voice for change. The big, beautiful bill didn't fix Social Security taxation, but it gave us time. Time to plan, time to prepare, and time to thrive through this transition.
And remember, it's not just about your Social Security. It's about your entire retirement income picture. With the right plan, you can reduce surprises and keep more of your money in your pocket.
If this episode has been helpful, please like it, share it with someone you care about, or leave a comment. We'd love to hear your thoughts. And if you're ready to talk about your retirement transition, Karl and I offer a complimentary consultation. You can reach us at 832-698-2010, or go to the comments section, or actually go to our website at bfinancialpartners.net. This conversation is for educational purposes only and isn't intended as legal or tax advice. You need to contact your attorney, your CPA, enrolled agent, your financial advocate or advisor, and work with your team, which is so important. I want to thank you, Karl, for joining me today. I have been wanting to have you on my show for so long, and it's such a pleasure. And also sharing your expertise is wonderful.
Thank you for having me, Vicki.
You're welcome. This is Vicki Joern, reminding you to be financially prepared for today and the uncertainties of tomorrow.